Let's look at types of orders. The first order we're going to explore is the market order. Next is the limit order. Now, a limit order could be marked as day or GTC. What does GTC mean? Good till canceled. Now, with a limit order, time priority applies. Another type of order is a stop order. Stop order could be a day order or good till cancel, GTC. We're also going to be looking at a market at open and market at close order, a fill or kill order, FOK, immediate or cancel, IOC, and all or none. Let's look at the details as it relates to these orders. The first order we want to explore is the market order. Customer enters a market order. Their order will be filled immediately. Their order will be filled immediately. Now, we don't know what the price will be. So if a customer wants a guaranteed execution, but they don't care about price, then the market order is the order that should be used. Let's take a look at a limit order. A limit order. We could enter a buy limit or we could enter a sell limit. Let's start with a buy limit. Start with a buy limit. With a buy limit order, the investor is going to buy at their limit price. They determine their limit price or some price that is better. Now, if I'm buying, what would be better than my limit price? Some price lower than that. So the limit price is the upper price, the top price. So my order will be filled at my limit price or better. And if I'm buying, what would be better would be a lower price. The order is placed below the market. So we're going to enter an order to buy 100 shares of ABC at 25. Now this order could be a day order or GTC, good to cancel. What if it is a day order? What does that mean? Well, if the order is not filled by the end of the day, the price was not reached by the end of the day, the order is canceled. So we have 1 day to fill the order. What if instead the order is marked GTC, good to cancel? Then the order stays on the books until the order is filled or is canceled. So let's say that this was marked as a day order, marked as a day order. So again, the order is buy 100 ABC at 25. So we want to buy 100 shares of ABC stock at $25 or better, which would be $25 or lower. Now, let's say that the price of the stock is currently trading at $26. 26. The next price is 27. The next price is $25.50. The next price is $25.25. And the market closes. We never got to 25 or lower. Therefore, this order never filled. This order was canceled. This order never filled. This order was canceled. What if instead this order had been entered as a GTC? Price 26, nothing happens. 27, nothing happens. 25.50, nothing happens. 25.25, nothing happens. Market closes. Next day, market opens at 25. We hit our limit price. We hit our limit price. Are we going to get an execution? Well, remember, time priority applies. Let's say that there was an order ahead of us, already on the books ahead of us. That order gets filled before our order does. Next price is $25.25, then 26, then 27, then 28. Our order never gets filled because there was an order ahead of ours. There was stock ahead of ours. There was an order in front of our order. The limit price was hit, but our order was number 2 on the books. The first order got executed. Price after that went back up. Our order did not get executed. So that would be time priority. Time priority. Now, let's take a look at an example again. We're number 1 on the book. We're number 1 order on the books. So when we hit 25 or better, our order is going to be filled. So would 26 do anything? No. 27? No. 25.50? No. 25.25? No. 25? Well, our order fills at 25 because our limit price was 25. What if instead of 25, the next price had been 24? Is 24 better than the limit, better than 25? Is it lower? Yes. So the order would fill at 24. So the order in this case will fill at a price of 25 or lower. 25 or lower. Okay? 25 or lower. When would I use a buy limit order? Let's say that I've been researching a company. And I like this company. I like them a lot. I've looked at their annual report. I've tracked them for several weeks. They're currently trading at $30 a share. The price of the stock is currently $30 a share. I like the company, but I don't like $30 a share. I think that's a little high. If this stock were to ever pull back to $25 a share or less, I would like to buy it. So I would enter a buy limit order. I would enter a buy limit order. Now let's look at a sell limit order. With a sell limit order, I'm going to sell at my limit price or better. At my limit price or better. If I'm selling, what is better than my limit price? Well, something that would be higher than that. Something that would be higher than that. The order is placed above the market. So I enter an order to sell 100 ABC at 30. Now this could be a day order or good to cancel. Time priority applies, which we've already discussed, so we're not going to look at that again. What would happen if the stock in the market were trading at $28 a share? Nothing. 29, nothing. 28.5, nothing. 27, nothing. 26, nothing. My limit price or better has not been met, therefore the order will not be filled. What about this? Let's look at some prices again. What if the market price is 28? Nothing happens. 29, nothing happens. 28.5, nothing happens. 29.50, nothing happens. Next price is 30. The order will execute. I'll sell 100 shares at 30. What if the next price after 29.5 were 31? Well, that's better, that's higher, I would execute. What if the next price after 29.5 were 32? That's higher than my 30 limit, it would execute. So my order will fill at $30 or better. $30 or better. I would use a sell limit order when I own a stock. It had a nice little run up to $30 a share, but I didn't sell it. It's pulled back. I don't want to sell it at $28 a share. I think it'll get back to 30 or above. If it does, I want to sell it. So I would enter a sell limit order. I would enter a sell limit order. There's a stock that I'm looking at right now. Okay, that stock, I own it. It's trading at about $100 a share. It's pulled back from its high. I think it'll make it back to its high, and if it does, I want to sell it. So I would enter a sell limit order at the high of 102, whatever the high may be. Now let's look at the stop orders, buy stop and sell stop. Now, stop orders are also known as stop loss orders. Stop orders are also known as stop loss orders. So with a buy stop order, my order will be triggered at my stop price or higher. Triggered at my stop price or higher. The order is placed above the market. Once triggered, then the order becomes a market order and executes at the next price. Now, I'm going to use a buy stop order to stop a loss in a short position. I'm going to use a buy stop order to stop a loss in a short position. So I shorted XYZ stock. I shorted that stock for $30 a share. Now, I am bearish. I think the price of that stock is going to go to $20 or $15 or $10 a share. But I could be wrong, and the price of that stock could go not down, but could go up. And if the price goes up, then I'm going to be losing money. So I want to enter a buy stop order to stop my loss in a rising market. So I'm going to enter in a buy stop order. Buy stop 100 shares of XYZ at 35. Now this could be a day order or GTC. Now remember, I sold this stock short at 30. My concern is the stock is going to go up in value. If it goes to $35 or higher, I want to get out of this short position. I want to stop my loss. So I enter a buy stop 100 XYZ at 35. Now at 35 or higher, my order will trigger and become a market order. So the price of the stock in the marketplace is 31, nothing happens, 32, 33, 34, 35. Well, the order will trigger at 35 or higher. Would 36 have triggered the order? Sure. Would 37 have triggered the order? Sure. It's going to trigger at 35 or higher. I triggered at 35. It becomes a market order and executes at the next price. I don't know what that next price will be. That next price could be anything. It could be 35, it could be 37, it could be 40, it could be 25. I don't know. But I know that I triggered at 35 to stop my loss. Let's take a look at a sell stop order. A sell stop order is used to protect a long stock position. I buy XYZ stock. I think the price is going to go up. But I want to protect myself, and I want to stop my loss if the price goes where? Down. If the price goes down. So sell stop is going to trigger at my stop price or lower to stop loss on a long position. The order is placed below the market. Let's say I bought XYZ stock for $35 a share. It's had a nice little run up to $45 a share. So I got a $10 profit built into this stock. My concern is that the price of the stock may start to drop back and I start losing that profit. So I want to enter a sell stop to stop loss of my profit if the price of the stock falls. Now remember, I bought the stock for 35, had a nice little run up to 45. I'm concerned about a pullback, so I'm going to enter a sell stop order for 100 XYZ at 40, could be day or GTC. If the price reaches $40 or lower, my order will trigger, becomes a market order, and executes at the next price. So the stock price in the market is 43, nothing happens. 42, nothing happens. 41, nothing happens. Price hits 40. My order will trigger. Would 39 trigger my order? Yep. 38, you bet. 40 or lower. Now, once triggered, my order becomes a market order and executes at the next price. Do I know what that next price is going to be? No clue. Next price could be 40. Next price could be 43. Next price could be 32. I don't know. All I know is I'm going to trigger at 40 or lower. 40 or lower. Now let's take a look at some specialty orders. The next order we want to look at is the fill or kill order. Probably see that on the test as FOK. So I enter a fill or kill order to buy 100 shares of ABC stock at 25. That order is entered. If the entire amount of the order is not filled immediately, then the order is canceled. Fill or kill. Fill the entire amount of the order or cancel the order. No partial fill. Next is immediate or cancel. Immediate or cancel, IOC. I put in an IOC. Fill what you can, cancel the balance. So I put an order in IOC to buy 300 shares at 30. The order is executed upon entry, 100 shares at 30. The balance of the order, the additional 200 shares, will be canceled. So here we have a partial fill. And the last is all or none, AON. Enter an all or none order, fill the entire order over a period of time. If the entire order cannot be filled, then it would be canceled. Now, I could enter an all or none day order. Fill the entire order, and you have all day to do it. If you can't fill it, at the end of the day, cancel it. Or it could be marked GTC. I'll give you a week, and if you can't fill it, cancel it. So here, the difference between an FOK, fill or kill, and an AON, all or none, fill or kill, fill the entire order immediately, not over time. All or none, fill the entire order, but you have time in which to do it. So those are our different orders.